Welcome. Today is Sunday, March 1st, 2026, and this quick start video will show you how and why to read the forecast charts on TSFStocks.com. TSF Stocks forecasts specific limit order prices for each trading day, published 1 week in advance. Historical validation shows an average of 80% probability of profitability, and all of that data, every forecast and every result, is right here on the site for you to review independently. Past performance does not guarantee future results, but you're basing your decisions about whether to open new positions or trade on a stock on the past performance of that stock. TSF's forecasts build a map of normal. They show how a stock should perform under normal conditions. The forecast chart helps you determine if conditions are currently normal for the stock. Let's look at the forecast chart for Lockheed Martin. Each forecast consists of a gold line, the actual forecast value based on the historical close prices of the stock, and a green zone, the confidence bands that define what the normal values of the stock are for each day. The intraday low price is plotted as the solid black line, and the intraday high price is the dashed black line. A buy signal fires when the intraday low price drops below the forecasted lower band price. Each buy signal shows up on the chart as a dark red dot that marks the entry price of the position. Now you may notice that not all of the red dots relate to the lower band of the green zone in the historical forecast value. This is because the historical map of normal is revised each week when the new forecasts are generated. This isn't a bug, it's a feature. Every forecast value on the chart is selected by comparing up to 540 competing forecasts for that date. The forecast with the best historical pattern of accuracy for that date is selected, including the confidence bands for that forecast value from that forecast model. To make sure the new forecasts have the greatest possible accuracy, the historical patterns of accuracy for the previous month are updated each week. This can change the shape of the historical forecasts, it can move the confidence bands, and it can create buy signals that no longer make sense. All of the historical data that you can download for each chart includes the actual buy signals and the actual historical entry prices. If you want a more detailed explanation of how the forecasts are built and how the historical patterns of accuracy are calculated, you can find all of that in the methodology section. Now notice that the gold line, the actual forecast value based on the historical close prices, mostly stays between the intraday low and high prices over the past 6 weeks. 6 of the 7 buy signals are very close to the actual intraday low prices. The forecast map for Lockheed Martin is stable and consistent. Now let's look at the chart for United Health Group. This stock has not been behaving normally. The last week of January was a major disaster. The stock price took a dive, so every forecasted limit order price filled, and it filled at a very, very bad position. The stock didn't recover during the following week either. The buy signals were still a lot higher than the stock price was trending. Now, from February 9th forward, the forecast seems to have settled back to normal. The gold line is in between the dotted line for the high price and the solid line for the low price, and this now reflects the actual pricing of the stock. How you respond to the forecast chart depends on when you're viewing it. If you are considering opening new positions in UNH today, take that recent volatility into account. The TSF timing signals are incredibly resilient. They have survived virtually every major market shock in the past 20 years. UNH is now showing 3 full weeks of recovery, and that's the minimum I personally would need to consider opening any new positions. This buy signal on February 23rd is exactly where it should be for a position trade. But what if you were looking at the chart on January 28th, 2026? You placed your limit orders for the week, and maybe you opened 2 positions. You opened one on January 26th and then one on January 27th. But at market close on January 27th, when you see that massive price drop, you would cancel all future limit buy orders because the current conditions are so abnormal, you can no longer trust the forecast map for the rest of the week. Every new position opened under these conditions will be a very bad buy signal. The chances of making any profit, let alone the 5% profit, are unacceptably low. When reality breaks like this, all you can do is pull back and accept that you might have 1 or 2 open positions that you'll need to hold on to for longer than usual to get any kind of a profit. You can't prevent the bad buy, but you can limit the damage. But sometimes it's the forecast that breaks, not reality. And when that happens, you can prevent a bad buy signal. SMCI is a perfect example of a bad buy signal that could have been avoided by looking at the forecast chart. The forecast for Friday, February 13th, 2026 is an obvious outlier. A sudden, isolated, single-day spike in the forecast value is suspect. The isolated spike created a forecast buy limit order price that was significantly higher than any recent price over the past 6 weeks. The chances of this position closing at a profit are extremely slim. Before you place your weekly limit orders on a stock, check the forecast chart for the week ahead. Unexpected single-day spikes in a forecast price point to bad buy signals. They don't happen often, but when they do, you can see it in advance so you can ignore them. Single-day price drop forecasts can also happen. Let's look at the coming forecast for Lockheed Martin. The All Forecasts model predicts a sharp price drop on March 4th, followed by an immediate recovery the next day. This means the limit order buy price for March 4th is much lower than the limit order buy price on March 3rd or on March 5th. This is not a problem. In the worst case scenario, the price on March 4th drops, but not that far, and you miss a potentially profitable buy signal. In the best case scenario, the price drops on March 4th and triggers an extremely undervalued buy signal that captures a genuine opportunity.